Today's topic, I'm going to discuss a few issues regarding interest rates on annuities and how there's a correlation between the Fed increasing interest rates and then how that could make annuity accounts more favorable versus if the Fed starts decreasing interest rates, how that could have a trickle-down effect in making it less favorable. So how to take advantage of the current opportunities, and then most importantly, making sure that you're avoiding the most common mistakes. The first example of a mistake is you have a whole slew of carriers that offer fixed annuities or fixed index annuities. Majority of those carriers offer a shitty low rate of return. So in order to obviously capture or have access to the best rate of return, you're going to want to understand how the math works and then how to avoid some of the smoke and mirrors approach that these carriers provide. So I'm going to go over a few different annuity accounts, then what we've been seeing across the board and how to take advantage of those. If you're interested in speaking with a specialist at any time, feel free to give our 1-800 number a call. It's 1-800-566-1002. Reference this video, ask to speak to a specialist, and we'll make sure that somebody gets in contact with you. So whenever we're looking at fixed annuities, a fixed annuity just provides a fixed interest rate. It's similar to a bank CD, which is a bank certificate of deposit, with slight variations. Typically, when you're looking underneath the hood on the top 5-year, 3-year, and 7-year fixed annuities, those have been favorable. Those are the nice sweet spots. Now, when I'm saying avoid the common mistakes, what do I mean by that? If we're looking at a 3-year as an example, simply put, if you're receiving a 5% rate of return on the best fixed annuity for 3 years, that means you're going to receive a 5% the first year, 5% the second year, 5% the third year, and you would have a compound interest effect of 5% on those 3 years off of the premium dollars that you placed into that specific insurance company that was giving that offer. After 3 years, an individual will typically take the monies and then look for whatever the next best option is on a 3-year or 5-year or 7-year. So there's different ways on how you could create laddering strategies. As an example, typically a 3-year, let's say, is paying 5%, versus a 5-year might be paying 5.5%, versus a 7-year might be paying 5.6%. So if somebody wants to take advantage of the current interest rate environment that's paying these high rates of return, instead of placing all their dollars into the 7-year and get that 5.6%, an individual likes to have flexibility with their liquidity. So what they would do is create maybe a portion of their dollars for the 3-year. So when the 3-year comes due, they would take all the money that they placed in there, what they've accumulated, and roll it into a new 7-year. In 3 years, the 5-year will have only 2 years left before that would come due, and then the 7-year would have 4 years left when that comes due. So maybe when the 5-year comes due in 3 subsequent years, they would take the money and purchase a new 7-year. When the 7-year comes due, purchase a new 7-year, so that now you're always having this trickle-down effect of higher interest after 7 years, 5 years, 3 years. You're always taking advantage of that higher interest rate environment. So with the rates, when we're scaling back and we're looking at the Fed increasing interest rates, they've increased it at unprecedented levels. Before, when the interest rates were lower, you might have had a 5-year that was paying a 3% rate of return or a 2.75% rate of return. Well, because there was an increase in interest rates, it gives the companies a better opportunity to provide a higher rate of return to the individual, to the prospect, to the individual that's looking to take advantage of this interest rate environment. So they're saying if they could make more money but still be profitable offering somebody a 5.5% rate of return, they would look at the mathematics, they will look at the actuarial data to say, okay, we can make this offer. From the individual standpoint, they're placing X amount of dollars in, and they're getting that, in this example, 5.5% every year. This is more for the individual that says, I don't care about what happens with the market. I just want to have a safe, consistent rate of return on my money, and I want to know if the market gains 20%, I'm gaining 5.5. If the market loses 10%, I'm gaining 5.5. So it's just slow and steady with how an individual could leverage this fixed opportunity. If, let's say, somebody is risk averse and they absolutely hate leveraging the market to grow their accounts and they only want to be in fixed related accounts, but they want to have a little bit more flexibility than only utilizing a 3-year, 5-year, and 7-year. Maybe they want to utilize a 6-month or a 12-month or an 18-month or a 24-month or 2-year. They could go and leverage bank-related products to kind of fill in those holes. So you could do that same sort of laddering strategy. Maybe they're setting up a 1-year bank CD, a 2-year bank CD. When this 1-year bank CD comes due, they collect whatever the payment was and the interest, take that money and purchase a new 7-year as an example, or a new 5-year, or however long they want that laddering strategy to work. Because if, let's say, a 1-year is paying 4% rate of return, a 2-year is paying 4.5% rate of return, but then that 3-year is paying a 5% rate of return, what they might have done was use a bank CD for the 1-year, a bank CD for the 2-year, a fixed annuity for the 3-year, a fixed annuity for the 5-year, a fixed annuity for the 7-year. So there's a whole slew of different ways on how to essentially skin this cat. It's based on what you're trying to do, what is ultimately your goal for this money. Is it for an inheritance maximization that you just want to leave monies to beneficiaries? Do you want to leverage this as a type of cash flow strategy to say, I want to collect the interest and live off the interest based on my accounts and make sure that they're spliced out properly? So there's a multitude of different ways on how to do this if you're looking for the fixed only strategy. Now, be mindful, there's other types of strategies. So that's where I'm going to go into the fixed indexed for the individual that says, I want to have growth of my money when the markets are doing well, but I want to have that peace of mind if the markets go down that I'm not losing a dollar. So it's not the fixed, it's not just the constant, it's going to ebb and flow. It's going to increase or gain zero, increase or gain zero. So in this example, this is where protected growth accounts come in. And to give you a overall timeline on fixed indexed annuities as an example, and you also have banks that offer something called market link CDs, which is a similar type of process. But how this is growing is somebody's placing dollars in there. So let's say if it's a rollover, then they would be creating an account within an IRA, so it's staying within a pre-tax. If it was a pre-tax qualified 401k account, they would create a qualified traditional IRA account. That would be the contribution that they would be placing in there, and it's technically a transfer or it's a rollover, so it's keeping it from qualified to qualified. The way on how this grows, the rate of return is either going to be positive or it's going to be 0%. So in the past, when you had lower interest rate environment, an individual needed to go into these 10-year and these 12-year and possibly these 7-year restricted accounts. So what that means is, let's say if somebody was in a 10-year, the 10-year would offer a higher cap rate or a higher participation rate than a 5-year. So if we're using an S&P 500 as an example, as the index, we understand that with all these accounts, it goes by the contributions or the transfer that somebody's placing in there and the rate of return that's coming back. Because this is a protected growth account or a fixed indexed annuity with no bells and whistles, with no income riders or death benefit riders or anything like that that will have a cost with it, the rate of return will be positive or it's going to be 0%. Meaning it's going to gain whenever that index that's linked to it has an increase on its anniversary date, or it's going to gain 0% if that index goes down. So it's going to give that person the peace of mind to say, I'm going to grow whenever the market that's linked to is increasing, gain 0% whenever it goes down. When you're looking at a 10-year account, an S&P 500 on a 10-year account can have a much higher cap than on a 5-year account. So there's an incentive there. The individual is placing their money into a 10-year restricted account because they're saying, I'm going to have a higher cap limit, higher potential rate of return. That's what the cap limit's going to do. Is if you have a higher cap limit, that means that it gives you a higher potential rate of return than you would with a 5-year. Similar to, why would you go with a 7-year fixed annuity versus a 3-year fixed annuity? The 7-year could produce you a higher rate of return than the 3-year. So that's the incentive for somebody to place their money in there for that duration of time. Same sort of concept. And when I'm talking about in the past, the 7-year, the 10-year, the 12-year used to be a nice sweet spot, was because the 5-year accounts that were offered had such low cap limits and such low participation rates because the interest rate environment was correlated to that. Now when we fast forward, you have amazing 5-year accounts and 7-year accounts, so an individual does not have to restrict their monies for 10 years and for 12 years just to get a reasonable rate of return on their dollars. When I'm saying restrict their account, what do I mean by that? And some products, some companies give different nuances to this, but as a very easy example, let's say you have a 5-year restricted fixed index annuity versus a 10-year restricted fixed index annuity, and they're both offer 10% free withdrawals starting from the first day, 10% free withdrawals each year for up to that set duration of time, and then 100% access after that set duration of time. So as an example, let's say you're set up with a 5-year account. Your account's going to grow whenever the market that's linked to that increases, gains 0% whenever the index goes down. On the 10-year account, it's going to grow whenever the market index that's linked to it increases, gains 0% whenever that index goes down. Let's say that someone wants to leverage this sort of account for a type of growth play or a type of income-related strategy to say, hey, I want to pull out, 5% of my money or 10% of my money every year to use it for income, to use it for my retirement-related expenses and make sure that I'm at least producing enough cash flow that is greater than or equal to my expenses and basically create a proper income strategy. With the 5-year account, this individual could access up to 10% per year from typically whatever their account balance is. Same thing with the 10-year. And they could do that each year. The difference is after 5 years with this account, they could have full access to their monies. They could either leave their account in there, but now know that there's no restrictions to access, no restrictions on the liquidity on how they could actually pull the monies out after 5 years. Versus this one, this individual can only fully remove the dollars after 10 years. Because if, let's say, after 5 years, the individual has an account that's growing in this 10-year account, after 5 years, let's say they say, oh, screw it, let me just take all the money out, they're going to get dinged with a surrender penalty. This one, after 5 years, they have full access to their monies. Now, if let's say we use an example that after 3 years, this individual wants to remove all their monies. With the 5-year account, they're going to get dinged with some sort of surrender penalty. 10-year account, they're going to get dinged with some sort of surrender penalty. So in order to have full access to your dollars without, meaning penalty-free access, with a 10-year restricted account, they'd have to wait 10 years. 5-year restricted account, they'd have to wait 5 years. So this is where, with the new interest rate environment, if you do not have to restrict your money for 10 years because you have favorable rates of return, you have high interest rates, you have high uncapped, high participation rate strategies available with these good 5-year accounts or 7-year accounts, you don't have to succumb to the 10-year and the 12-year restrictions that you used to have to basically utilize in the past. Meaning a year ago, 2 years ago, 3 years ago, when interest rates were so low, the only way to get a reasonable rate of return was by biting the bullet and say, all right, I guess I'll just restrict my liquidity for the next 10 years, for the next 12 years. So I hope that that example makes sense because it's a really good opportunity when someone's looking at the current interest rate environment, anytime the Fed is increasing interest rates, that has that trickle-down effect on the fixed accounts and the fixed indexed accounts, which will give you that peace of mind. If you want to leverage a fixed account, you know what your interest rate will be every year, regardless of whatever the market's doing. If, let's say, you want to kind of diversify but still stay within that risk-averse mindset to say, I'm absolutely terrified of the market, I don't want to mess with the market at all, I want to use a portion of dollars towards fixed, a portion of dollars towards fixed index, because the fixed index could give me a higher growth opportunity than just the straight fixed. What's the best solutions there? So this is kind of a nice 1-2 punch for an individual that has conservative money set aside to try to get them to their specific goal or accomplish what their specific goal is. So they could blend out their strategies a few different ways. They could have it set up with fixed only, with fixed indexed only, with fixed and fixed indexed only, or they could go and leverage a slew of different opportunities with fixed indexed, and investments. With investments, we understand if we think of that bucket idea, and you have monies that are sitting, as an example, in an IRA, when it's sitting with investments, the rate of return is either going to be positive or it's going to be negative. You have unlimited growth potential, unlimited loss potential. Let's say a way on how an individual could go and try to create a strategy for investments would be diversified, maybe a combination of stocks and bonds or international stocks, U.S. stocks, commodities, gold, oil, silver, real estate indices, fixed income related assets. So there's a slew of different ways on how to do this, but there's no guarantee on it that it can't go down. And what we saw was every time the Fed kept increasing interest rates, bond values and bond funds have been getting hit hard with that. So that's where you could create a different diversified blend, but using the shorter term sweet spots with the fixed accounts and the fixed index accounts in correlation to the investments, because allow the investments to do what it needs to do. If, let's say, somebody has $500,000 that they're trying to grow, they're somewhat risk averse. Maybe that might mean leveraging $200,000 into a fixed account, $200,000 into a fixed index account, and then using $100,000 and going gung-ho, going balls to the wall. I want to go into low-cost index funds. This $100,000, I want to try to grow as much as possible, but I understand if the market is unfavorable, then I could, lose all that value, or I could have large losses to this. While that's happening, these other portions of dollars are being preserved and protected. So it gives it a nice diversification that the opportunity was not available before, because the reason why I say the opportunity wasn't really available before was because an individual, in order to get a reasonable rate of return, they'd have to really stretch out their restrictions on an indexed account and a fixed account. So I hope that all that makes sense. So the common mistakes, and it's very important to understand how these common mistakes work. For fixed accounts, you might have one carrier that's giving a 5-year fixed annuity as an example, and it's saying, hey, we're going to give you 5.25% rate of return. For second place might be 5.10% rate of return per year for the next 5 years. The 5.25% rate of return, they might have a hidden rider fee in there to say, oh, if you want to pull out any money or you want to leave your account balance as a death benefit, we're going to charge you 25 basis points, 0.25%. So an individual that sees the nice shiny object of, oh, I'm getting a 5.25% rate of return, but they didn't realize that there's also a fee of 0.25, when all said and done, their net is only at 5%. Versus maybe the second place option, which looked like second place on the surface, 5.10, has no fees, no riders, no restrictions. That's going to give you a proper net of 5.10%. So the math is going to be higher for what on the surface looked like the second place option. This is now obviously the first place option after you're incorporating fees in there. The second aspect that individuals should tend to avoid would be too many restrictions. So let's say if you have a company that's giving a 5% rate of return versus another company that's giving a 5% rate of return, but one company only allows you to have access up to 5% of a free withdrawal each year for those first 5 years, versus another company that's allowing you to have access up to 10%. And let's say that financially, both of these companies are appropriate, they're correct for your situation. Obviously, go with the one that has less restrictions. Then there's a few different ways on how those restrictions come about. And that's something that we help dissect. What are the top options? And then show you clear as day, no, you don't want to go with that company, you want to go with this company. And we're experts when it comes to these specific fixed accounts or fixed index accounts to essentially navigate throughout the bullshit that these insurance companies have. You have hundreds of different offers. For the individual, yes, they could go and research this information on their own, or they could leverage an independent financial agency such as ourselves to do all the hard work for them and to make sure that they're getting set up with whatever the best process is, whatever the best contract is for their specific area, for their specific goals. Surrender schedule length. If let's say you're going set up into a 10-year fixed account and they only allow you to access up to 5% per year of a free withdrawal, well, you just screwed yourself because you sat into a 10-year account versus maybe a 5-year account. Let's say if a 5-year account was paying 5% and a 10-year account was paying 5%. Unless you felt like interest rates were really going down and you just wanted to stay locked into that 10-year, it might make more sense because you have flexibility after 5 years to take the money, look at whatever the next best solution is at that time, and then place it into more of that shorter term duration. So you want to look at the surrender schedule as well. And those are really the main things, to realize on a fixed account basis. What are the rider fees? What's my overall net? Are there any sorts of restrictions? What are those restrictions? Does it really make mathematical sense to do it? Or are those restrictions really not that big of an issue for you? And then really that surrender schedule length. When it goes into fixed indexed accounts, this is something you have to be very careful on. When you're looking at your indexes, are they capped or are they uncapped? Obviously, it would make more sense to go with uncapped indexes. What's the participation rate? So, as an example, let's say you have an index with one company that has uncapped with a 150% participation rate versus another company that's offering that same index, XYZ, uncapped with a 90% participation rate. In that example, if all other aspects of those accounts are pretty much identical, this one company, the first company, if this index gains 10%, this individual is receiving a 15% credit on their account. Versus the second company, if this index gains 10%, this individual is only receiving a 9% credit onto their account. That's a 6% difference for the same exact index, for the same exact type of product, type of account. So this is where be very careful on whether something is capped versus uncapped, what the participation rate is, what the spread rate is. All those different features can be the difference of you receiving thousands of more dollars of growth or thousands of more dollars of income throughout your retirement years than not. So be mindful of that. Also, allocation choices. Maybe you have a whole slew of uncapped indexes and one company is giving you 10 different options to choose versus another company only is giving you 2 options. Well, if all things are pretty identical, we'll go with the one that has the more plentiful options. Long-term accounts, if you don't need to get set up into a 10-year restricted or a 12-year restricted duration, and you could accomplish that same need with a 5-year restriction, go with the 5-year. It makes no sense other than with the agent that's going to be selling you, their incentive is going to be trying to place you into a 10-year and a 12-year over the 5-year because they would make a higher commission with that specific 10 to 12-year account. The right thing to do is to look at the situation, see exactly what's going to be the most mathematically appropriate, and then take advantage of that opportunity so it's giving the individual the most amount of flexibility that will correlate to their retirement needs. And lastly, matching up your risk tolerance. This is very important because an individual could love the idea of, I want to have growth when the market goes up, not lose when the market goes down, or they might say, I only want fixed. But then when we're looking at what their risk tolerance is, and we use artificial intelligence software to figure out pinpoint exactly what somebody's risk tolerance is, what their risk score is, if it's coming back that a person's risk score is off the charts because they're so risk tolerant, well then maybe a fixed account and a fixed index account isn't going to be your bread and butter. That's not going to be where you should place the majority of the dollars on. Subconsciously, you probably want to take on more risk, and that might mean leveraging investments that are going to ebb and flow with the market because that could give you a higher growth opportunity. And vice versa. Maybe somebody that is saying, oh, I love the market, and we look at what their risk tolerance comes back at, and it's super risk averse, well then maybe fixed accounts and fixed index accounts are going to be the way to go because you're going to be really pissed off when the market goes down. But a fixed account is not going to have that problem. A fixed index account is not going to have that problem because there's certain safety metrics put in place. So I hope that makes sense. And some different top solutions on how somebody could itemize their specific situation is always breaking down their retirement goal into 3 things, the 3-thing scenario. Number 1 thing is income. Do you have income coming to you where you no longer have to go to work, meaning that you're hitting your retirement age or retirement stage, you no longer have to go back to work, and your income is greater than or equal to your expenses? If that is the case, if your income strategy is complete, well then you could move on to step 2, which is emergency need. Do you have anywhere between 6 to 12 months of what your expenses are to some sort of liquid account that you could access at any time? If you've already accomplished that, then you can move on to that step 3, growth stage. The growth stage is the cherry on top. This is where you can mix and match and say, okay, these are really more of my fund monies. This is something I'm trying to grow my account, maybe as an inflationary-based protection, as an inheritance maximization, as a vacation fund, whatever that is, and then make sure that this growth strategy is appropriate to your risk tolerance, appropriate to what you guys are trying to accomplish. We are different than other advisory groups throughout the country. The upper level version of what I'm talking about is we have proprietary products that we leverage, and then we have trademark strategies that no other advisory groups have access to. From the more kind of Cliff Notes version of that, somebody comes to us because they don't like being bullshitted on how a specific product works, how a specific strategy works. They want to understand the over level of it. They want to understand the 30,000-foot view. Hey, where am I right now? Am I good for retirement? This is when I want to retire. How exactly do I get from point A to point B successfully? And us showing you, not just through mathematic and scientifically how to do it and have it explained to you on a boring basis, we try to make sure that the education is tailored specifically to how you like to learn. So a confused mind makes no decision. We want to make sure that you understand what you have, that you're going to love getting set up with us, love the process, and at the end of the day, if it's something that we're not a fit for your situation, well then at least you know what is available. You know what are some of the steps, what are some of the common accounts, some of the common strategies, and at least you're now more knowledgeable to either do it on your own, leverage a different advisory group, or stay put with us and understand the value that we'll provide for you on a daily basis, annual basis, all throughout your lifetime, holding your hand to say, okay, this is exactly what you should be doing. Okay, this is a change that's happening with the interest rate environment. This is a change that's happening with the current market environment, and this is how to take advantage of what those changes are. So it's never just staying stale. It's always making sure that you're consistent, that it's more of a tortoise in the hare type situation, but you're also capturing those opportunities available. If you are interested in having a conversation, feel free to give our 1-800 number a call. It's 1-800-566-1002. You give us a call 24 hours a day, 7 days a week, and we would make sure that if we're not available or if an advisor is not available for you then, that we'd schedule something specific for your calendar, specific what works for your specific schedule. I thank you very much for watching this video. If you want to see some of our other content, feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.